Morning, everyone. I want to thank you all for joining us for this February edition of the CAPIS monthly research briefing. My name is David Choate. I'll be the host for this morning's presentation. Today, we have the pleasure of having Nick Colas and Jessica Robb from DataTrek. In addition to sharing their macroeconomic perspective, Jessica and Nick will be taking some questions at the conclusion of their presentation. Please use the Q&A button at the bottom of the screen to enter your questions, and we'll try and get them answered. Finally, before I turn it over to Nick, if you're interested in DataTrek services, I encourage you to reach out to DataTrek after this presentation or to your CAPIS sales rep, and we'll get you some more information. So with that, I turn it over to Nick Colas.
Thank you, David, and thank you all for taking the time to listen and really appreciate your time and attention today. It's been a kind of a interesting start to the year, so we'll be discussing that and what happens next. Basically, we're going to review three topics today. The first, very briefly, but I think importantly, we're going to look at how U.S. and global equity markets have performed year to date. It is actually the first half of the first quarter is actually over as of yesterday, so time's really flying. So we'll take a look at how results have shaped up both in the U.S. and around the world in terms of stock market performance. Then we'll move on to our second topic, which is to discuss what's going on right now, what's driving equity markets right now, because I think there's a lot of, I wouldn't say confusion, but certainly consternation about why markets are trading the way they are, particularly with such low volatility. So we'll discuss that. And then finally, we'll give you our outline for how we are thinking about the back half of Q1 2023, as well as the rest of the year. So moving on to our first topic, how have things done year to date? Let me just throw out some numbers at you to give you a framework to think about this. The S&P, as of last night, all these numbers are as of last night, price-only returns and dollar-based returns to give you a sense of where we're coming from. S&P 500 up 8%. Through yesterday evening. NASDAQ up 15.3%, Russell up 11.3%. So a very nice bounce back. Now, granted, we were very oversold at the end of last year, and part of what we saw so far for Q1 is a bounce back from very oversold levels in December because of tax loss selling, but still a very solid return. And more importantly, the U.S. is beating rest of world in equities. So if you look at the MSCI rest of world, meaning MSCI all country ex-US, it's only up 7.6% year to date. So S&P up 8, MSCI ex-US up 7.6. So US is beating. Why is that? Because it wasn't the case in January, but we've had a bit of a pullback in rest of world. Emerging markets are underperforming the U.S. year to date. MSCI EM is only up 5.8%, which is a little bit strange, right? Because the China reopening was supposed to really help EM, and it has helped China. So Chinese MSCI China is up 8.1%. So beaten the S&P 500, great. And Taiwan also up 10.6%, so great. But Brazil and India, which are the other two big weightings in MSCI EM, they're down 3% in the case of India and only up 2% in the case of Brazil. So what's happened is all that money that went into Brazil and India last year when everybody thought that China was uninvestable is just coming out of Brazil and India and going into China and Taiwan. South Korea is up about 7.5%. So South Asia, China is doing fine, but rest of EM is not. Where things are going much better is in Europe. EFA is actually outperforming the S&P 500, 8.5% this year versus the S&P's 8%. And that's all Europe, by the way. Europe, MSCI Europe, up 10.4% year to date. Japan's only up 5%. So the great irony of Q1 so far is that the Chinese reopening that was supposed to help the Chinese economy, and it clearly is to some degree, is actually helping European stocks more than emerging market stocks. EM is helping, the EM China reopening is helping European manufacturers, both Germany and France, big exporters to China, are up over 10% year to date. So they're doing fine. It's not helping Japan, as we discussed. But so far for the year, the real story has been Europe to some degree and the US, much less so emerging markets, much less so anything other than, say, China and Taiwan. Final point on this, and then we'll start moving on to our second topic. The U.S. outperformance versus rest of the world is not entirely all U.S. big tech. So yes, Tesla's up 74% year to date. Facebook Meta's up 47%. Apple's up 20%. So big tech is getting a big bounce back after that very oversold December. But the equal weight S&P 500, the RSP ETF, is up 8.4% year to date, so slightly better than the S&P's 8%. So it isn't just big tech. Tech has definitely helped, but there is some fundamental strength in U.S. equities. We also saw that with the Russell being up 11%. So there is some strength in U.S. equities year to date. And that brings us to our second topic. Why have stocks been so resilient? We hear this question from clients literally every day right now. Not only are why they're so resilient, but why is volatility so low? And that really is confusing people. You know, when we had these calls last year, we told you the VIX was the thing to watch. You buy them when the VIX goes to 28 or 36, and you sell them when the VIX gets close to 20. That has not worked this year. The VIX has been trading consistently below 20 since January. It started the year around 21. It was 18 and change last night. And yet we've had this very nice rally. So a big change from what we saw last year. So what's going on? Let's just start with why things shouldn't be as strong as they are, because I think there's a long laundry list of kind of what's wrong with this market. So let's go through that before we give you our discussion of what we think the market's focused on. The bottom line here is that the economic data since the start of the year has been very strong in terms of U.S. economic data. So think about the January jobs report, up over 500,000 jobs. January retail sales up 3%. January inflation, both CPI and now PPI today, running higher than expected. Initial claims for unemployment insurance, which is a very good data set and pretty robust, is running below 200,000 initial claims a week. Those are numbers we haven't seen since the Vietnam War. And the Vietnam War was in the 60s, and we had a workforce that was roughly half the size of what we have today. And yet initial claims are just as low on an absolute basis as they were 50 years ago, which is amazing. The US labor market continues to be very, very strong. That tells us something kind of important, and that is that the Federal Reserve may have made something of a mistake by downshifting to 25 basis point increases. We did 75s last year, as you all know, did a 50, and then we did a 25. That slowing of the rate cycle now looks like it may have been premature, because as we start 2023, we're having some very good economic data. That is forcing the market to reconsider what the Fed is likely to do over the next couple of meetings. So for example, at the beginning of the year, the market was convinced we're going to see one, maybe two 25 basis point increases at Fed meetings at the start of this year. We'd peak out around 4.75% for Fed funds. And by the end of the year, the Fed would be cutting rates because there'd be either a very marked slowdown in the economy or an outright recession. And we'd end the year around 4.25%. That was what the market believed in the first week of January. Because of all the economic data, which has been so strong, markets really revised pretty dramatically what it thinks is going to happen over the balance of the year in terms of Fed rate policy. It now thinks the Fed's going to raise rates 3 more times, take rates to over 5%, and by the end of the year, rates will still be over 5%. A month ago, if you looked at the Fed funds futures probability chart, you'd see that the market was thinking maybe 10% chance that the year-end rate would be 5%, which, by the way, is what the Fed's expecting. Now it's over 70%. So a pretty big shift. You've also seen a big move in one-year Treasury yields, now running about 5%, telling you that the Treasury market also believes Fed funds and Fed rates will be higher for longer. That's, a very, very big difference from where we were then to where we are now. And the equity market has been absolutely resilient, as we discussed. First half of the quarter, very strong, low volatility. We're getting a little bit more chop today, but we'll see how the day closes. We've had several days where it looked like the market was going to roll over, and yet things turned out fine. So what's going on? And we wrote about this to our clients last night because it really is something, as I said, we're getting a lot of questions about. And I think the bottom line is this. Earnings expectations, while Q4 has not been great in terms of earnings reports, we haven't beat expectations by very much. The earnings comps are quite weak. Things look kind of slow. We're still going to do $53 a share on the S&P 500 in Q4 of 2022. And let's put that number in some context. It is 29% better than the average quarter between 2018 and 2019, the pre-pandemic peak of roughly $163 a share, works out to about $41 a quarter per a share for the S&P. So we're doing roughly 29% better right now in kind of a frankly, crappy earnings season for Q4, we're doing 29% better now than we were doing pre-pandemic. So structural earnings power in the S&P is 29% higher than it was in 2018 and 2019. Now, why does that matter? Well, think about it this way. S&P ended the year at 2019, roughly 3,200. We're up 28% from that. So earnings are up 29%. And the S&P is up 28%, sort of point to point from pre-pandemic to now. That's what the market's really looking at. It's saying, okay, we get it. There might be a little bit of a recession. Things are slowing down, but look how powerful S&P earnings are. Look how powerful corporate earnings are in the US versus where they were pre-pandemic. We had a big surge in demand, which certainly helped profit margins, and we're holding on to margins pretty well. Now, if we get a recession, if we get more slowdown, then yes, we've got to cut our cost structures and basically create a recession, but we're not getting that yet. Demand in Q1 looks like it's going to be pretty good. The Atlanta Fed GDP Now model shows roughly 2% GDP growth for Q1 in the current quarter. If we're going to get 2% GDP growth, earnings should be kind of flat, and $53 a share is probably a pretty good number. Moving on to what analysts expect for the next couple of quarters, no surprise, it's the same. It's roughly $53 a share, a little bit lower in Q1, a little bit higher in Q2. But again, we're holding these very high levels of corporate earnings power, which I don't think people pay enough attention to. They kind of look at the earnings season versus expectations, but the absolute comp that I've just shown you, first of all, it explains why we are where we are in the S&P. And secondly, I think it kind of explains why we're not melting down, even as clearly the Fed has gotten maybe a little bit behind the curve. That's basically why we're holding in. That's our perspective. You know, it's very hard to have a big crack in the market unless you have a big downward revision in earnings expectations. We had that last year. A year ago, believe it or not, market was looking for $250 a share in S&P earnings a year ago today, basically. It ended up being $225. So a pretty big decline, 10%-ish. That's why we had a meltdown. That's why we had it down 18% S&P in 2022. In 2023, we're not getting that kind of erosion in earnings power. The earnings models have been reset, the streets reset their numbers, and now we can do $51, $52, $53 a share. Still much better than they were pre-pandemic, and still kind of holding in. Let me just sort of touch on one final point before we move on to our last point of the day. There is a lot, and I mean a lot, of circumstantial evidence that we're going to get a real recession this year. And I'll just point you to the very classic yield curve inversions that we've seen, the difference between 3-month or 2-year and 10-year Treasury yields. If you Google New York Fed Recession Probability Model, you will get an analysis the New York Fed has done for years that compares 3-month to 10-year Treasury yields and then imputes a recession probability based on that spread. And the logic behind it is pretty straightforward. 3-month Treasuries are basically Fed funds. That's the market's take on Fed funds now and in the near future. 10-year Treasuries are the market's assessment of neutral rates, meaning rates that neither expand or contract the economy. That's what the 10-year tells you. When Fed funds are significantly above the neutral rate, you should expect a recession because that's what the Fed is trying to engineer, a dramatic slowdown in the economy. If you look at that New York Fed model, right now, it has a over 50% probability of a recession in the next 12 months, just based on that 3-month, 10-year spread. It's the highest probability that model has had since the early 80s, since the Volcker recession. We haven't had that high a number going into the financial crisis or the dot-com bubble blowing up or the 1990 Gulf War. None of those things reached 50% probability. The current environment has. Now, we might end up skirting past a recession, but the yield curve has been a very good indicator, not necessarily of what a recession, what's going to cause a recession, but how brittle the economy is and how susceptible it is to a recession. So for example, 1990 yield curve inverted, and we had the shock of the first Gulf War. 2000 yield curve inverted, and we had the shock of dot-com and 9/11. 2007, we had the financial crisis, yield curve was inverted then. And 2019, the yield curve inverted, and we had the pandemic crisis in 2020. Not to say the yield curve foresaw any of those events, but it did show that the economy was on very thin ice, and we're back there right now. So it's entirely reasonable to worry about a recession, even though we've had a pretty good start to the year. Now, let me sum up with our final point, which is kind of what happens next. I'll just give you some thoughts about what happens the rest of this quarter and then how to think about the rest of the year. In terms of the back half of the quarter, I think we got to be cautious here. Equity markets have done a great job, as we discussed, kind of defending the 4,000 level on the S&P, because they strongly believe corporate earnings power can be $50, $51, $52 a share. And if you put a 20 multiple or 19 multiple, even an 18 multiple on $50 to $53 a share, you get current levels. So we're kind of at fair value, and that's fine. However, we do have to pay attention to the fact that the Fed is going to have to keep raising rates. This economy just will not quit. Labor markets remain strong. Output remains reasonable. If you look at on yesterday's retail sales report, the biggest comp was restaurants and bars. Restaurants and bar revenues were up over 20% year over year, and up 7% seasonally adjusted from December. Now, if people are going out to eat and drink that much, we are not anywhere near close to a recession. It's pretty much that simple. Demand remains very strong. As much as people talk about recession, we're just not seeing it in the data, and it's not even close. So at some point, the market's going to have to accept the fact that terminal Fed funds might be closer to 6%. I don't think equities can hold up very, very well in that environment. We're seeing some of that kind of selling off today, but I think the back half of the quarter is going to be very choppy. The rest of the year, we're a little more constructive on, frankly, but perhaps not for the best, meaning the most bullish reasons. As a lot of you know, I'm a very long-time cyclicals analyst. I covered the autos in the 90s for First Boston, started my life covering Ford and Chrysler and GM in 1991, did that for 9 years, did that for Steve Cohen at the old SAC from 99 to 01. So I have a very specific point of view about how markets work. And in terms of what drives markets, it's always earnings surprises. We discussed how earnings have been surprisingly good over the last quarter, and that's been helping markets. However, what really creates earnings surprises after recessions is all the cost cutting that happens going into a recession. That's why earnings upside occurs. That's why stocks bottom and begin to rally. And so I really do strongly believe we need to see some kind of moderate recession with dramatic cost cutting. We're only starting to see that now in order for markets to bottom and to create that next bull market on the way back up. I understand people want to kind of short circuit this process and not have to deal with the recession or the layoffs, and I totally empathize with that. But if you look back at every recession, what creates the bottom is a fear that corporate earnings will continue to decline. And once the cost cutting hits, they start to increase rapidly. It's very exaggerated in the autos, but it's true across all industries. You're seeing some of that in tech right now, for example, but it's going to be a kind of a slow burn to get things going again. We do need some kind of greater drawdown in the US economy to create that need to rationalize the cost structure and create the next leg of earnings. So we're looking for a bottom sometime in Q2 or Q3, a very investable bottom. Once the market gets truly afraid of a recession and even a recession begins to hit, we just aren't there yet, which is why we're really cautious. And I would love to come and tell you, like, look, this was the bottom back in October, and we can go work from here. There are a lot of technical factors that do support that kind of bullishness, but at a fundamental level, it's just a very hard story to tell. So I'll wrap it up by saying we're very optimistic on US equities over the next 5 and 10 years. That's not the issue. The question is, where do you really put your bets at the market lows to maximize returns in 2023 and going into 24 and 25? And we should absolutely be through the inflation issue, absolutely be through whatever recession we have, and corporate earnings can really bounce and we can do quite well past this year. But for the next couple of months, we're definitely still cautious. I would encourage you to, think about, where you want to be positioned in such an environment, and plan to be bullish when people finally give up. So I see we're at 11:20 now. So I'd be happy to take any questions from David or the rest of the team.
Well, Nick, you say we're expecting a bottom. How low do you think that could be? Is it back to October or is it back to last summer? How much do we have to be prepared for?
So I think about it this way. The high pre-pandemic was 33.87. And that was with these earnings of roughly $160, $165 a share. That was in Feb of 2020, right before things fell apart. I think it is reasonable to set that as the target. A lot of equity markets outside the US have gone below their immediate pre-pandemic levels and now beginning to crawl their way back. The US markets held up remarkably well relative to those. And that's why I highlighted the Q1 performance, because the US is kind of back to being on its winning ways. But in terms of valuation, in terms of taking all of the pandemic related gains out of the system, I think the healthiest level is 3,400 or 3,387, which was that high in Feb 6, I think it was, of 2020.
Okay. On the topic of earnings, you said we're up 29%, right? Over that period of time, and the market's up 28%, or maybe I got those two backwards. How do you figure that happens with the inflation of raw goods? It happened, everybody's had to increase the cost of an employee, right? Everything's gone up. Have they just passed the cost on to the consumer? Is that just what we're seeing? And how long can the consumer accept that?
Yeah, it's a great point. It was very front-end loaded. Profit margins peaked out in Q2 of last year, 13% on the S&P, 13.2%. They've been coming down. So we kind of hit max margin a year ago, basically. And that's frankly why the market rolled over in Q1. It saw that peak margins were happening and margins would be coming down. So to answer your question, yeah, we can't pass that along as much as we used to. The peak margin was when folks had a lot of money to spend and those cost issues were not as prevalent. If you look at the S&P earnings right now, they're down 3%, 4%, 5% year over year. So corporate earnings have not been a great inflation hedge, to your point. Exactly right. And that's going to continue. The next couple of comps are all going to be negative. We are technically in an earnings recession. Year over year earnings comps are negative. The other interesting point, which kind of your question points to, is if interest rates are so much higher now than pre-pandemic, why haven't we seen more of a discount rate, a higher discount rate on those earnings? Why are we still trading 18 times earnings, which seems kind of silly if rates are 3.5% instead of 2% as they were pre-pandemic? And this is something where I don't have a great answer, honestly, but that's why I focus on earnings so much, because earnings just explain the market better than some kind of modification around interest rates. As much as rates matter, as long as rates don't cause a recession, I think the market tends to look through them. If the rates cause a recession, then we're back to focusing on earnings again. So I worry less about whether the 10-year is at 2.5, 3.5, or 4.5, and more about whether or not earnings are going up or down or margins going up or down.
Are we going to have another argument about what counts as a recession?
Yeah, we probably will. We probably will. Yes, very good point.
Yeah.
Yes. Yeah, we had one last year. I guess we'll have one again this year.
Yeah, it's become a political conversation. I get a question from the audience that says, what sectors, if you had to position yourself for the next 6 months, what would you avoid? What would you overweight?
We like healthcare a lot. Healthcare has a lot of good things going for it. It's still reasonable valuation relative to history. Earnings revisions, we look very closely. So whenever we look at a sector, the first thing we look at is earnings estimates going up or down, because for the overall market, estimates are coming down pretty badly. Healthcare is a bit of an exception. A lot of healthcare names revisions are actually flat or going up. So we like healthcare a lot. Consumer staples, honestly, I did not like until I did the work for clients this week. And there's a lot of positive revisions going on in consumer staples. Yields are higher than the S&P. Valuations are not awesome, obviously. We're trading 24, 25 times earnings for the big consumer staples names and 21 times for the group. But as a safe haven with good dividend yields and earnings revisions to the upside, we like that group. We still like energy, even though oil prices have really fallen apart. I think energy is cheap, and still very cheap in valuation. The entire energy sector in the S&P has less of a weighting than Apple. So energy, I think, still has valuation potential to the upside. The areas where I would be taking profits right now, I think tech had an awesome run. And if you held on tech at the end of last year into this year, bravo, great call. It was a gutsy call and it worked. I'd be lightening up on anything big tech related here and kind of getting ready for this next downdraft.
Okay, I got two more questions if we got a couple minutes. The war in Ukraine, equity markets seem to have just forgotten that exists. So the question, to what extent do you agree with us? Has it happened? And what's your overall take on how the war could or could not impact the performance of equity markets in the foreseeable future?
Yeah, great question. We look at that conflict from a market standpoint. Obviously, it's a human tragedy, so let's just put that out there. At a market level, one thing matters: oil prices, and that that event spiked oil prices to over $120 a barrel in March of last year. And it revisited, this is WTI we're talking about, WTI revisited 120 in June going into summer driving season. It's 75.80 right now. So even with China's reopening, even with Russia, Ukraine, even with a still strong US economy, oil prices have collapsed. I mean, 75.80 is below a year ago levels. So it's quite amazing. As long as that conflict doesn't hurt oil prices or doesn't lift oil prices, I think it is kind of a non-event. My contacts in Europe who were talking to me nonstop about this a year ago have moved on. They're really excited about the Chinese reopening, getting German industrial exports going again, French industrial exports going again. So that's the China reopening seems to have taken a lot of the air out of that discussion, out of that fear, which is also good. But oil prices are the thing I watch. And, for right now, they're saying it's a non-event, but that could change.
I got two more. They keep coming in. They won't let you go, Nick. US dollar's been active. How does this bode? How does this bode for gold moving forward?
Yeah, great question. You're right. Yeah, dollar is super interesting. I mean, we do a lot of work on the dollar just in terms of like how fast it should move off the top. The top on the dollar was, I think, October 16th of last year in terms of the nominal dollar index. It's down roughly 6% since then, 7%. The typical move off a new high, whether you're talking 09 or 2020, is 13-14%. So the dollar is about halfway through its move if we continue to see further weakness. Now, I would have thought the dollar would have rallied a lot more on the rate picture that we've been discussing on this call, meaning higher rates for longer. You think that would help the dollar, and it really hasn't all that much. And which tells me like it's not just earnings that are really helping markets, but it's just a fundamental confidence, like we're through the worst of it and we're going to have a recovery, both here and around the world, and that'll pull the dollar down. So I think the dollar continues to weaken, but that's a kind of a shaky call right now, honestly, because if we do get more and more strong economic data, dollar is going to have to rally. The yield spreads are just too broad between here and rest of world. As far as gold, the thing that intrigues me about gold is we're just seeing structurally a lot more buying from central banks. The World Gold Council does some great work on this, and they just published something on this in their 2022 review, which is online and free. And it showed that central bank buying in gold is the highest since 1967, last year. Central banks around the world want to buy more gold. They want to support their currencies, and they want to ideally create an alternative payment mechanism through their central banks for dollar-tied assets like gold, but without having to go buy treasuries or use U.S. bank accounts. So gold's, I think, pretty bullish. I've always liked gold. I always think 3 to 5% is the right place to be in terms of a portfolio allocation. But I'm pretty impressed by gold as proving to be still a relevant asset after 5,000 years, even today.
And no, I know you really don't get into individual stocks, but the one question that comes up when you say lighten up on big tech, the question comes: does that include Microsoft, which seems to have the joker in the AI conversation that we all have seen over the last few months?
That's a great point. I mean, no, it does not include Microsoft. Not just for AI. I mean, Microsoft's an interesting company because it doesn't have that core franchise like an Apple does. It really is just been a whatever works in computing they're going to get involved with, whether it be cloud or OS. I think they finally have found like a hallmark thing that they can really tap into. If by the way, if any of you have not used ChatGPT, you absolutely should. It's a fascinating technology. Like, it's free to use. It's great. It's very interesting. But yeah, no, Microsoft is not on that list. I'd say anything that's moved over 30% is on that list. Even Apple's kind of on that list. But no, Microsoft seems to have a one-off set of stories right now that looks pretty cool.
All right. Well, I thank you for all those that are on the call. If you don't have access to a voice like Nick, you reach out, let us know, and we'll get you talking to him more regularly, because we really appreciate your perspective. Thank you very much for joining us.
Thank you. Y'all have a good day.
Thank you all. Bye-bye.